Hey there, how's it going? I'm Christian with Plan Your Federal Retirement, back with another video with our All About FERS series. Really excited today. We had someone call in and leave a really good question relating to taking money out of FERS to use as a down payment on a house purchase. And there's a lot of different nuances in order to answer that question. It's not just a yes or a no, if this is a good idea or not. There's really important language here that we have to be paying attention to. So I thought it'd be helpful to make a video on it to help you guys make an educated and informed decision if this was something that you were thinking about doing yourself. So let's listen to Dominga's question now.
My name is Dominga, and I'm calling to see if I could borrow money from my FERS to put a down payment on a house. Thank you.
So really good question, Dominga. And the first thing I heard was, can we take money out of FERS to put a down payment on a house? So my mind first is going to the FERS retirement system. The dollars that is being taken every 2 weeks from your paycheck to go into FERS, not necessarily TSP. TSP would be something different. So if you're planning to take money out of your FERS to pay for a down payment, this would be essentially a withdrawal of your FERS contributions, which definitely would not recommend that. In fact, the only way you would be able to do that is if you separated from service, left service. You'd be able to request a withdrawal from those contributions that you've put into FERS. And I don't think that's what you're asking. I think what you're asking is, can you take a withdrawal out of the TSP? So in that case, we could consider either doing a loan or a withdrawal to pay for that down payment. So the first thing we want to think about is, should we do a loan? Should we take out money and borrow money to be used for that down payment? I would just probably say no. So let's say we're going to the bank and we're asking for money to buy a home. And they say, great, we'll give you the loan. We just need you to put 20% down. So if you go on the outside of that to go borrow money from another account, probably not the best idea, because now you've just increased the amount of debt that you have. The bank's going to come back and say, well, now you've got more debt that you just borrowed from to now not be qualifying for this loan, or maybe you would qualify for less. So don't think a loan in this case would make sense if we're financing it with the mortgage and we need money for the down payment itself. So really the other option would be taking money out of that TSP as a withdrawal. So if you're over the age of 59 and a half, you can take money out of the TSP without an early withdrawal penalty. That early withdrawal penalty is 10%. There are exceptions, financial hardship exceptions within the TSP, which has some unique rules. If you have some sort of financial hardship, you can take money out of the TSP to help pay for that financial hardship. And you can go and get clarification on what those rules are on the TSP website. Not going to go into that today. So this isn't the case, right? If we're buying a house, this isn't going to be a financial hardship. So that's not an option. The other option that you have would be to take money out of the Roth TSP if you have Roth TSP contributions before age 59 and a half, right? The money that is going into that Roth account, we've already paid the taxes on it. So let's say we've put in $1,000 into that Roth TSP account. That $1,000 grows to $1,100, let's say. Well, the $1,000 that we've already paid taxes on, we can take that out at any time. We don't have to be age 59 and a half. We've already paid the taxes on those contributions, what's better known as the basis in that Roth account. That's very important. If you have those Roth TSP contributions, you would be able to take what you've contributed out of that account, but prior to reaching age 59 and a half, without any taxes, without any early withdrawal penalties. So that is left to be said. If you're under 59 and a half and you don't have Roth contributions, then the pre-tax account that you would take out of the traditional TSP would be subject to those 10% early withdrawal penalties plus income tax. We really don't want to be paying that 10% early withdrawal penalty by taking money out of the TSP. That really wouldn't be a smart idea. So if you're over the age of 59 and a half and you're still working, you can take money out of that traditional TSP, pay the taxes on it, but not that early withdrawal penalty of the 10%. So that could be another option. The other rule says with the TSP is if you retire over the age of 55, you can start taking money out of the TSP. Again, you have to be retired at age 55 or older. If you're regular FERS, it's even younger if you're special provisions. But at age 55 or older, you can start taking money out of the TSP if you've retired without an early withdrawal penalty. You would still be paying that income tax though. You have other options as well outside of the TSP, of course. Maybe you have an old 401k. They might have some unique rules similar to the TSPs. You could also look at taking money out of your retirement accounts, maybe an IRA or a Roth IRA, kind of paying attention to that 59 and a half age or not. The IRAs themselves have a $10,000 withdrawal amount for a home purchase. So you can take out up to $10,000 to buy a home without that early withdrawal penalty. So that could be an option if we're looking for a down payment. If I'm meeting with one of my clients and we're looking at funding a down payment for a house purchase, now that we know all the rules as far as taxes go, now we have to think about, well, what's the best practice? What's the best option to finance this home? And generally speaking, I would not recommend taking money out of the TSP or the Roth IRA, especially if we're still working, if we're still got many years ahead until our retirement to purchase a house. It could be a little bit different, if we're closer to that retirement age or we're in retirement to, of course, spend those retirement dollars. But if we've got many years ahead of us working, these retirement accounts are really meant for retirement. We really want to try to avoid reaching into our retirement accounts and taking money out because of that compound growth that's inside of there. That's one of the reasons, right? There's going to be more in there if we just left the money in there. It could potentially be setting some bad habits as well, right? If we think of this account as just a spending account that we can use for anything other than retirement, then what's to say that something else wouldn't come up in the future that we would just reach into that retirement account to spend, especially if we've got plenty of years away from retiring. So I tend to caution clients away from doing that. But it is an option. And again, it's good to know the rules that you have available to you. Probably a better option, something to be looking at would be looking at, just money that you've saved in a savings account, a money market, checking savings, right? And maybe some other outside of investment account outside of the TSP, some brokerage account, something that is not earmarked for retirement. And so that would be this kind of the thing to be thinking about is keeping those retirement dollars separate from any sort of house purchases, unless we're really close to that retirement age or we're in retirement, right? So I mentioned the early withdrawal penalty, if that applies under age 59 and a half, but not for the Roth. And then we talked about those income taxes as well. So the other thing to be thinking about with income taxes, if we take money out of a pre-tax account, is that we would be subject to federal income taxes, but also possibly state income taxes if that applies to you. Thinking about this even further, income taxes, if we took out a big lump sum to make a house purchase, even if it is for a down payment, that could possibly put you in a higher tax bracket, especially if you're on the cusp of going from one tax bracket to the next. And reaching in, taking a lump sum out could put you in a higher tax bracket. So you really want to be thinking about this from a tax perspective as well. What's going to make the most sense for you from a tax perspective is really how we want to be looking at this. So I hope you found this video helpful. If you have a question either related to this or another question about your FERS benefits or your FERS retirement, feel free to leave your question below in the comment section, or you could also call our phone number. I'll leave it up here on the screen to submit your question. Leave us a voicemail and share what your question is, and it might be featured on one of our next videos. Of course, be subscribed so you get our latest videos and content we put out. And until next time, happy planning.